So that is why we say bank reconciliation is about reconciling the discrepancies that exist between the cash book of a company and the bank statement. So now, what are the causes of these discrepancies? What are the causes of these discrepancies? Number one, time difference. If there are outstanding checks issued by the company but have not yet cleared by the bank, yes, it can cause these discrepancies. We said that one is uncredited check. Also, if there are checks that you issued out, but the person you issued them to have not yet presented them to their bank to collect the money. So we said that one is a situation of an unpresented check. Also, there could be bank charges. Bank charges, there could be bank charges, there could be such as monthly maintenance fees, overdraft, transaction fees, which bank normally deduct from people's account. And all those deductions lead to, it can lead to reduction of how much you thought was in your bank. And also, there could be interest that you earn. There could be interest. Interest could be earned. Maybe you have money in your account. At the end of the month, the bank can decide to pay you interest. So, and it's added to your bank account. It can lead to your bank account. Your money, your balance will increase if bank pays you interest. So, if on the other hand, maybe you are having an overdraft or a loan, the bank can charge you interest, so it can reduce what you thought was supposed to be your balance. Also, there could be errors. The bank themselves can make error, and the customer can also make error in his own cash book record. Then we also have transactions that were not recorded. Transactions that were not recorded. There are direct payment. We call this one direct credit. Direct credit is a situation where maybe one of your customers have make a payment directly into your account, which you are not aware of. So it's a direct credit. And also, we also have a case of direct debit. Maybe you have, there's a standing instruction which you give to your bank to help you to pay bills, to help you to pay your suppliers, and the bank carry out this instruction and without informing you. In that case, it will be a case of direct debit. That is, debit means they took money from your account to make those payments. But in the case of direct credit, that means somebody paid into your account without informing you. And also, there are situations in this modern time, there are situations of unauthorized transaction. People these days, through cybercrime, cyber fraud, they can deduct money from your account unaware. So, because of these reasons, there can be discrepancies. Like we said, the timing, maybe you pay check into your account, but that's not yet declared. It can lead to discrepancies. And also, you issue check to somebody as a form of payment, and the person have not presented the check to his own bank to collect money, is a case of unpresented check. Then we could have bank charges could also affect it. And we also said that another thing that can affect it, that if there's error in the cash book, there could be error in your own calculation. Even the bank statement, there could also be error. And also, we have unrecorded transactions where you give a bank instruction to help you make payment on your behalf. If those payments are made and you are not aware, it can reduce your balance. And also, if customer pay directly into your account unaware, you yourself you are unaware, it will reduce it will increase your balance. And also, there are fraudulent cases of all those era of cybercrime. There are a lot of fraudulent cases that can affect your balance. So these are what will lead to those discrepancies. But in an attempt to reconcile, the cash book and the bank statement, there are certain steps that we normally take. The first thing is to go to the bank, collect your bank statement. The first thing to do is to go to bank, collect your bank statement. The next is that you start doing a comparison of the cash book and the bank statement. You can use, you can start ticking what in the bank column, the bank column of your cash book, you match it with that of the statement of account. So any item that I've entered, and you can tick it. The ones you did not, that it did not appear in your cash book, you also mark them for investigation. So you can, that is the next thing, is to compare the cash book and the bank statement. Now, if you now have to, you have seen the areas that there are discrepancies, you now carry out further investigation. You now carry out further investigation. There are, first of all, you have to adjust your cash book for issues like bank charges, errors made. If there's an error, you correct the error, you adjust your cash book first before you can now look at issues of maybe unpresented check and uncredited check. Then at the end of the day, if everything is balanced, you will find out that your cash book balance and that of your bank account balance will be reconciled. Now, there are, of what importance is it to carry out this bank reconciliation? Of what importance? Number one, that for carrying out this bank reconciliation, you have to prepare a statement now. How is it important to have a bank reconciliation statement? Number one, it ensures that there's accuracy between the bank statement and the cash book, because that accuracy is necessary so that because the figure you have there as a bank balance will appear in your balance sheet. It will appear in your balance sheet. So if the figure is wrong, your balance sheet figure will not be correct. So you first of all ascertain that you will use this bank reconciliation statement to ascertain that our bank transactions and our cash book record are in alignment. So as to make sure that there is where we have done the correct job. The next is to prevent fraud. Bank reconciliation helps us to prevent fraud. Bank reconciliation statement helps us to prevent fraud, and it helps us to track outstanding transactions. I talk about unpresented check, that is check that you issued out and the person have not presented it to his bank to clear it. And also, we also have an uncredited check that you pay to your bank, but it has not yet go through the clearing system and clear it, and the bank have not yet credited your account. And also, it helps you to trace if there's any money that was supposed to have been deposited into your account that was not deposited. It helps you to trace all those things. And also, if you can see that if there's a withdrawal from your bank account, which you cannot explain why that withdrawal was made. So we said that this bank reconciliation statement helps us to track transactions. It also helps us to manage cash flow. It helps us to manage cash flow, and it helps us to detect error. And finally, it helps us to comply with the accounting standard. It helps us to comply with the accounting standard, and all these help us to do what we call for decision making, because in accounting, the essence of almost every accounting activity is to aid the company in order to make a decision making. So we now want to quickly look at how to carry out a bank reconciliation statement. To carry out bank reconciliation statement, the first thing you do, you write down the balance as per cash book. If you write down the balance as per cash book, then you had, if there's any unpresented check. What we mean by unpresented check are checks that you issue out but have not yet been, you issue them out to maybe to your supplier, to your workers, to anybody. You use it check as payment, but the person has not gone to bank to make the withdrawal. So these are unpresented checks. So they also presented the total of them, you add it to your balance as per cash book. Then you less the uncredited check. The uncredited check are the check you pay to the bank, but the bank have not cleared it and credit your account. So if you do this, what you will receive will be the balance as per cash book, will be the balance as per bank statement. So this is the process of bank reconciliation. We have understood what bank reconciliation means. When the discrepancies normally come between bank statement and cash book, and also what normally causes it. And now we have also looked at how to carry out the reconciliation. And we said that this bank reconciliation statement is important because it helps us to adhere to accuracy in financial record. It helps us to prevent fraud. It helps us to track outstanding transactions. It helps us in cash management. It helps us to detect error, and it helps us to comply with standards. And also, it helps us to facilitate good decision making. Now, another topic that we will quickly look at in this accounting tool is partnership account. So first of all, what do we mean by partnership? Partnership refers to financial record and procedures used to partnership accounting. It refers to the financial record and procedure used to track the financial activities of business owned by two or more individuals. So when we are doing partnership accounting, we are trying to track financial record and procedures used by a business owned by two or more individuals. So let's look at what do we mean by partnership. Partnership is a business relationship between two or more people who agree to share profits. They agree also to share losses, and they agree to share loss, and they agree to share risk. So in a partnership, it can be two or more individuals, but that have agreed to they want to share. If there is profit, they will share it. If there is loss in the business, they will share it. If there is risk, they will share it. So in doing before a partnership can stand, there must be a partnership agreement. There must be a partnership agreement. And that partnership agreement is also referred to as the deed of partnership. It's also referred to as the deed of partnership. So in the partnership, in the deed of partnership, there are certain things that must be there. That agreement, there are certain things that must be there. Number one is that the name and address of the partnership. That is the business, what will be the name of the business, and what will be the nature of that business, and from which location will the business be carried out. Maybe your business will be carried out in Lagos. The business you are doing, maybe you are into ceramic. Maybe the business you are doing, maybe you are into buying and selling of rice. Maybe the business is you are into cement sales, or maybe you are into the business of selling of clothes and fabrics. So the name of the business, you must state it, and also where the location of the business. The next thing that must be in that partnership deed or the partnership agreement is that the name and addresses of partners. The name and addresses of partners. It must also be stated, the name and addresses of partners. Number three, the partnership purpose. you must state why you people have come together to do business. What are the objectives that you people want to achieve with that business? And you also have to specify the duration of the partnership. How long you people intend this partnership to last. You must state the capital contribution. You must state the how profit and loss are to be divided. If profit is made, how is to be shared. If loss are made, how is to be shared. And you must the partnership agreement must also state the roles, the partnership roles and responsibilities. The roles each partner is going to play in the partnership. And also, you can include other operational matters. You can state how issues of withdrawal will be treated. And also, if there's any partner that will be receiving salary, it will be stated. And also, you have to state the process of making decisions and how the accounting are going to be. If there's going to be a contingency plan, then you have to state it. And also, lastly, you must state issues of if there's a dispute, how can the dispute be resolved? If there's a dispute, how can the dispute be resolved? And because at times a partner can die, you must state how, if a partner dies, how is the matter going to be treated in the partnership? Maybe if the partner dies, maybe the wife will continue. Maybe if a partner dies, the son or the daughter will continue from where the father stopped. So you have to state what happens if a partner dies. And also, you have to, or like we said before, there must be stated how new partners can be admitted. And also, if you want to dissolve the partnership, what are the solution plan if you want to dissolve it? So, like we said, in partnership, we said that there must be a partnership agreement which include the name and where the company will be, also the name of partners, the purpose of the partnership, how long is the partnership expected to last, then the capital contribution of each partner, and also the profit sharing. How are they going to share profit? How are they going to share profit in the partnership? And also, what will be the role, what will be the function of each partner? And you also state if a partner withdraw money from the partnership, how is it going to be treated? And also state the way decisions are to be taken, how meetings are to be held. If there is dispute, you have to state how the dispute should be resolved. And in the case of death of a partner, you state how how it is treated if a partner dies. And also, how do you admit new partners into the partnership? So these are the things that must be clearly stated in that agreement. The issue here is that without an agreement, certainly in doing business, there are bound to be disputes, there are bound to be quarrels. So if there is an agreement, that agreement helps the partner to understand where they are going wrong and what they stated at the initial time of the partnership. And also, if the matter goes to court, court will always request for this deed of partnership. They will always request for the agreement so that they know what you people agreed upon even before the quarrel started. So the next now is, what are those accounts that we prepare the partnership account? We have the capital account, which states the capital invested by each partner. The capital account states the capital that contributed by each partner. And it's of two types. We have the fixed or the fluctuating, the fixed and the fluctuating capital account. The fixed capital account is that amount that is contributed is fixed. It's not, it doesn't change. But the fluctuating capital account is that when profit is made, it is added to the capital of the partner. When a partner when loss is made, it's less from the partnership, from the partner's account. So that is why we call it fluctuating, because if profit is made, the capital of the partner is increased. If losses are made, the capital of the partner reduces. If a partner make any drawing, take money from the company or so, it goes to reduce the partner's contribution. And also, a partner can decide to increase his ownership by contributing more capital. All those changes affect the account. If it affects the account, we cannot say it's a fluctuating capital account. So you either use the fixed capital account or the fluctuating capital account. The next account is the current account. The current account in partnership states the working that shows how much a business owns each partner. It records temporary changes to the business, such as profit shares, salaries, and drawings. So current account shows activities between the company and the partner. So now we have here, which shows if you are working on the current account, it has to be divided into two sides, just like the way we do it in the cash book. So on the debit side, we write down every balance brought down as debit. Then if the partner withdraw any money from the partnership, drawings are debited. If there's any interest on the drawing, they are debited. Then also, if there's any loss, it's also debited. But on the credit side, we look at how the balance brought down. Then we have, if there's any further investment by the partner, we credit it. If there's any interest earned by the partner on capital, we credit it. If there's any commission earned by the partner, we credit it. If the partner receives salary, we credit it. And if the partner get any share from the profit, we also credit it. So that is how the current account is run. So that is for partnership account. But this account is very, very important because in modern business, only one man cannot easily save enough money to do business. So it is expected that when you enter into a partnership with another person or more persons, you must have a partnership account. Which with this partnership account, it avoids quarrel, it avoids conflict, and the whole account can be easily looked at. So that is where we are ending this session. Thank you, and God bless you.